All right, let's talk about LVMH. We're diving into their massive third-quarter earnings report, a report that was so important it really sent a jolt through the entire luxury sector. So let's break it all down.
The very first thing you need to see is the market's reaction. I mean, look at that, a 7.5% pop in one day. For a company of this size, that is not just a small move, it's a huge statement. It tells you right away that these results didn't just meet expectations, they totally rewrote the story about a luxury slowdown.
So, what on earth was behind that massive reaction? Well, it all comes down to one really simple but absolutely crucial theme: a surprise return to growth. This was the first real glimmer of good news the company has put out all year.
And this chart just says it all, doesn't it? You can see that dramatic shift. After stumbling through the first half of the year in negative territory, the market was basically holding its breath, expecting more of the same. But instead, LVMH pulls out a positive 1% organic growth. Now look, 1% isn't a huge number on its own, but that swing from the red into the black, that was a massive psychological win, and a huge signal that maybe, just maybe, the tide is starting to turn.
But you know, the headline number never really gives you the full picture. You have to look under the hood. And when you do that with LVMH's massive empire, you see that this recovery was, well, it was anything but even.
And this table just lays it out perfectly. The undisputed star of the show was selective retailing, and that's really all about Sephora, which posted a phenomenal 7% growth. That incredible strength completely papered over the cracks in the group's main engine, fashion and leather goods, Louis Vuitton, Dior, which was actually still down 2%. So the takeaway here is pretty clear. Sephora basically saved the quarter.
Okay, so let's look at this geographically. You can see right away the revenue is incredibly balanced across the globe, which is a huge strength. But the really juicy detail was kind of buried in the conference call. Both the United States and, this is the big one, Asia swung back to positive growth. That turnaround in Asia was the exact spark the market was waiting to see.
So, the market was obviously thrilled. But what about management? How did they talk about these results? Well, let's just say they were nowhere near as excited as investors were. Their message was way more measured, really a tone of cautious optimism.
But even with all their caution, they gave the market the one soundbite it was desperate for. Right here, in the Q&A, they confirmed that demand from Chinese consumers, the single most important driver for this whole sector, is getting better. That little phrase, the Chinese that accelerated a bit, I mean, that was like a green light flashing on trading desks all over the world.
But here's the thing. For every piece of good news they gave, they hit us with a pretty stark warning. The themes were clear. Yes, Sephora is killing it. And yes, the US is getting better. But, and this is the big but, they went out of their way to warn everyone about stronger currency headwinds in Q4 and a much, much tougher growth comparison. They weren't just being cautious. They were actively trying to manage expectations down for the next quarter.
And this right here, this brings us to the central puzzle of this entire earnings report. You have two completely different stories playing out at the exact same time. Which gets us to the main question we have to ask. If management is waving these big red flags about the fourth quarter, why in the world did the market pop the champagne and send the stock flying?
This slide just shows the disconnect perfectly. On one side, you've got management being super cautious, talking about headwinds, and on the other side, you have the market being totally bullish and focusing on one thing and one thing only, that China is turning around. See, investors were already positioned for a terrible report, so any sign of life, any glimmer of hope was enough to spark a rally. Put simply, they decided to celebrate the Q3 win today and just worry about those Q4 warnings, well, tomorrow.
Now this gap, this big disconnect between management's cautious tone and the market's wild party, that's where opportunity lives. And that brings us to The Next Call, our segment where we cook up an outrageous but plausible trade idea based on what we heard. So here's the pitch. We think you fade this rally. Let's walk through it. Step 1, the setup. The market has clearly overreacted to one single data point. It's now pricing in this smooth, easy recovery that management themselves said isn't happening. Step 2, the catalyst. Those Q4 headwinds management warned about, they're very real. The tough comps, the currency drag, it all creates a very high chance of a disappointing report come January. Step 3, the rating. All this leads us to assign a short-term rating of underperform. The stock price right now just doesn't seem to reflect the risks management laid out so clearly. And that brings us to step 4, the trade. The opportunity as we see it is to short LVMH heading into that Q4 report, making a bet that the market's current euphoria is about to get a serious dose of reality.
So that's our take on LVMH's big quarter. And as always, this is not financial advice.